Let us look at this example. Yeah, this is come from figure 13.1 of your textbook. Yeah, we have this transaction. For example, on 1st July, okay, our beginning inventory, we have 10 unit. This is our 10 unit inventory. The cost is $10 per unit. So the total cost will be 100. So this is your cost per unit. Okay. Then you purchase additional inventories. On 15 September, purchase another 12 unit, but the price is no more $10. The price now is $11. So the total cost will be 132. 12 times 11 is 132. Okay. Later on 7th December, purchase additional inventory, 15 unit. So the cost is $12 now. So that costs you 180. So your total purchases here is 312. Add with the existing one, that give you 412. This is your total cost of inventories. Total cost of inventories. Later on, when you check your record, you sold 8 items, 8 units on 20th September, and you sold another 10 unit, that make it 18 on 12th January. On 12th January. So you have 8 and 10 here. Okay. So your total stock is 37. You sold 18. So your balance is, this is your balance. Your balance is 19. 19. The question is, for the 8 stock, what is the value? What is the cost? Are you going to use the $10, $11, or $12? Which one? Yeah. Okay. So it's subject. Okay. Some might say you use the $10. Some say you should use the $12 because when you stack the inventory, the new one is always on the top. So when you sell, you take the new one. Yeah, maybe there are arguments there. So how about the 10? The 10 unit. Are you going to use the 11 or 12 or this one? So this question is what we call as the cost flow methods that we're going to use, whether you're going to use FIFO, LIFO, or yes, it's depend. It's depend whether you're going to use FIFO, LIFO, or average. If you use first in, first out, when you sell the items on 20th September, this item will be the first one, the first thing available, yeah? That is this one, the $10. If you use the last in, first out, it will go to the last stock available. So that is the difference. So this is just a simple question that I raised to you to give idea how we should determine the value of your inventories. So the specific identification method under periodic is where the specific identification method require each unit sold and unit on hand to be identified with specific purchase or invoices. Yeah. The entity must use some form of identification, maybe serial number, stock take, barcodes to determine what is the cost for each inventory. If you have a specific method, you can identify when you scan the item, you know when did you purchase this item, what is the cost when you put cost of purchase for that items, for that stock. That is very, very strong, very good system. Yeah. We need a special technology for that. Okay. I'm going to show you comparison, yeah, comparison between this method. Okay. For example, We have a specific identification method. Okay, specific identification method. Our sales revenue is the same. Sales revenue is the same. Okay, our beginning inventory is the same, 100. Our purchase is 312, no different on that. But our ending inventory is different. If you use the purchase method, this is just example. Your ending inventory might be 210. If you use FIFO, your ending inventory is 224. You use LIFO, the ending inventory is 199. If you use the average method, the ending inventory will be 212. So different methods result in different value of your inventories. Okay, so your gross profit is also different. Your cost of sale is different. Your gross profit and net profit will also be different. So this is the impact of the costing methods. The costing method. If you use this periodic inventory system, you need to identify what is the correct value for your inventories. Okay. This is just an example, I repeat again, on how this four method reflect our calculation of cost of sale and profit. Your sale is the same, the sale amount is the same. Yeah, the sale amount is the same. The beginning inventory is the same. The purchase is the same. The difference is only the ending inventory. This is just example, yeah. Can you see here? Yeah, let me just go back to you. Yeah. The ending inventory, if you use specific identification, maybe 210. If you use FIFO, 224. If you use LIFO, 199. And if you use weighted average method, is 212. So since this is the critical point where it cause differences in your cost of sale, the impact will be cost of sale will be different, and finally your net profit will also be different. So every method, the lesson that from this diagram is every method will produce different value of inventories. The lessons from this figure is every method will result in different value of inventories. Okay, let us go one by one. Method number one is first in, first out. First in, first out. Abdul Rahman is the first guy who came to this class. When I say khalas, okay, wada'an, bye-bye, Abdul Rahman is the first person who leave this class. So that is first in, first out. First in, first out. Okay. That's just example of Rahman. Yeah, don't get embarrassed on that. Yeah, this is just an example. The FIFO methods of determining the cost of sale is based on the assumption that the cost of first unit acquired is the cost of first unit sold. The first unit acquired will be the first unit sold. Okay, let us look at this example. All right. Okay, let us go to the second concept. Last in, first out is a method where we calculate the cost by having assumption that the cost of last unit purchase will be the cost of first unit sold. Mean the new item will be sold to your customer. The real fact we are not sure, but this is more on calculation, our assumptions. The weighted average method periodic. The weighted average method. Sorry about that. The method average per unit is calculated by dividing the total cost of goods available for sale. This is our total cost divided by the cost of beginning and all net purchase by the total number of unit of sale. This is the average cost. We're calculating the total inventory cost divide the number of unit. So we get the weighted average cost. So this cost will be used to determine your cost of inventory, cost of sale, and gross profit later on. This is the comparison. Yeah. I'm going to show you one by one how we are going to do this. Yeah. Don't worry so much. Okay, let me go to the theoretical part first. Okay, sure. I will spend time. Yeah, a lot of time on the example, so you can see what are the difference between this method. Okay. So the costing method selected can have significant impact on the entity's reported profit and asset figure. So when alternative accounting method or procedure are considered acceptable in a given situation, consistency become important consideration. If you decided to use first in, first out method, okay, first in, first out method, so you must be consistent with your choice. But if you decide to use the LIFO method, so then you have to continue using the LIFO method. Same goes to the weighted average method. The important here is about consistency. The need for consistency does not completely rule out switching to alternative acceptable method if the new method result in improved financial reporting. For example, the accounting standard in your country prohibits the use of LIFO method. You use the LIFO methods. Maybe the accounting standard in your home country asks you to use FIFO method. So you should move to the better method. Maybe they have a good argument, reason for them.
Sir, sorry, I just have a question. When you said that,
Okay. In perpetual inventory system, an inventory card or inventory record is maintained for each item in stock. An inventory control account is kept in the general ledger, and the inventory record collectively constitute the subsidiary ledger for inventory. So they will keep for every inventory a record. Previously they used card, now we don't use card, everything is digital. Inventory purchases are recorded at cost in inventory control account and in the individual inventory cards or record. So we have the main, the big one, the master, and also each individual inventory record. So let us go to the first one. First in, first out. First in, first out. The cost of unit removed from the inventory is assumed to be from the first unit available. So this is the critical information here. The cost of unit removed from inventory is assumed to be from the first unit available for sale at the time of each sale. The cost of unit on hand, therefore, is composed of the most recent purchases. What you have here on your hand is the most recent items, the most recent stock. The identification of unit from separate purchases result in what are frequently called inventory cost layer. So let us look at this example. This is a FIFO method. I'm going to move very slow, Your beginning inventory, you have 10 units. Okay, 10 units. Okay. You purchase this inventory at cost per unit of $10. So the value of your inventory is $100. I repeat, you have your inventory. When you check your inventory, you have 10 units of item sandwich toaster, okay, whereby each unit costs you $10. So the total value for sandwich toaster is $100. $100. Later on, you purchase another 12 unit. That is on 15 September, you purchase new units of sandwich toaster, same brand, but the price now is $11. So that costs you, this is your purchases, that costs you $132. So originally you have 10, not 10, 10. You purchase another 12. So what happened to your balance now? Your balance is the new balance of your inventory is 22. 10 at price of 10, 12 at price of 11. But we cannot combine it together because the cost of purchase is different. So we're going to put our record here. We have 10 and 12. 10 and 12. 10 at price of $10, and we have 12, the new one, at $11. Let me just put here. This is the new one. This is the new one. Yeah, this is the new one. Yeah, the new one. This is the old one. The old one. Okay. Later on, you sold 8 units of your sandwich toaster to a customer. So the question arises here. So if you use FIFO method, which group of stock that you sold to your customer? Is it the $10 or the $11? Because you have two types here, two prices, $10 and $11. Yeah. Since we are using the first in, first in, first out, certainly the first in will be the old one. So I'm selling the 10 here, the $10. Yeah, the $10 stock. Okay, 8 units multiplied by 10. So my cost is 80. My cost is 80. My total cost of sale is 80. What happened to my inventory? I have 22. I sold 8. My balance is 14. 14. And this 14, I sold the 10. I sold the 10 here. 10 minus 2, the old one. So my balance now is 2. 2 unit of the old stock. 2 unit of the old stock. My new stock, 12 unit, remain unchanged, remain intact. So this is the new one. This is the new. This is the old one. The old one reduced from 10 to 2, from 10 reduced by 8 to 2. That's why we have 2 units here, 2 units, 8 and 2. Later on, I purchased another 15 unit, 15 unit of toaster. It cost me $12. So 15 times 12 is 180. Now I have 3 categories of toasters. The $10, $11, and $12. 10, 11, and 12. So I need to keep the record. So for the $10, I still have 2. For 12, I have 11. For 15, I have 12. Okay, so this is the old one. Put here, this is the old one. This is the new. This is the newest, yeah? This is the newest one, yeah? Okay. Then on 12th January, sold 10 units. Sold 10 units. So you have 3 types here. Which one you should sell first if you have 10 units? If you want to sell 10 units, you need to take the old one first. So I'm taking this one first, 2, the old one. This is the old one, the oldest one. Okay, 2. But I still don't have enough. I need another 8. So I'm going to take the second one, the $11. I'm taking out from this 12 and minus 8. So this is 8 units. Okay. For the 2, the cost is $10. Whereas for the 8, the cost is $11. So the total will be 108. 108. What happened to my balance? What happened to my balance? 2 minus 2, 0. 12 minus 8, 4. So this is 4. This is 4. And the new one still remain unsold, $15. So this method is what we call as FIFO method. FIFO method. FIFO method.